today we are looking at Bill Ackman's portfolio. He is a successful billionaire hedge fund investor. We're going to run through his companies that he holds to see where are the undervalued gems for a buy now. We're going to run through each one of these companies, looking at their historical performance. We're going to run through their dividend safety, looking at their strong financial metrics. And as always, we will run them through our valuation model, getting to our intrinsic value, finding our acceptable buy price given our investor margin of safety, and find out what Wall Street believe the price will be over the next 12 months. So let's jump straight into the first stock, which is Canadian Pacific CP, trading around $78.63. 2023, it was up around 5.5%. It didn't have the greatest year. It lags considerably behind the S&P 500, and we can see it is in the midpoint of the 52-week range. It offers a very small yield of around 0.72% and currently has a forward PE of around 27.83. Now, over the last 10 years, it is up around 160%, but remember, it doesn't include those dividends reinvested. So let's take a look. We see a dividend safety score of 76, market cap 73 billion, a large cap company. And when we take a look at those recessionary metrics for those who see a recession inbound in 2024, they maintained the dividend during the last recession. Average growth during 07-09 in line with companies in the S&P 500, but it trailed the S&P's negative 55% return, having a negative 64 recession return. Dividend growth, well, they haven't increased the dividend since 2020. On average, though, over the last 5 years, it has increased 12%, and over the last 20 years, we see around 11% increase. Now, as we did note, they don't have any years of consecutive dividend increases. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. So we have a sign here, in fact, of overvaluation. But as always, we're not looking at any of these models in isolation, and we're drawing our conclusions towards the end. Forward PE around 24.6, also sitting above the 5-year average of 22.3. And in comparison to the industrial sector PE, it's at 19.4. So let's take a look at the free cash flow payout. As always, earnings is susceptible to manipulation by management through accounting, as we have shown many examples in the past. Free cash flow, personally, below 60% is what I tend to target. Gives me faith that management can offer those essential double-digit dividend increases we love to see. And over the last 10 years, we can sit well below 10%. In fact, the last 2 years in the mid-20s, with 2023 expecting to be 32% once their annual report is published. So free cash flow per share, well, 82 cents in 2013, 278 in 2022. And we can see in 2023 it is expected to come down slightly, but we do note 2024, the expectation is a free cash flow around 347. Sales growth, we like to see 3 to 7% for steady moderate growth, and we can see 2022 at 10%, 2023 expected to be around 34%, so that is pretty good, especially considering that merger that did take place, as we have mentioned in the past when analysing Canadian Pacific. Total sales then, 6 billion in 2013, 2023 expected to be around 11.2, so they will have nearly doubled their top line over the period. And we can see from 2013 to 2021, 2020, they were doing share buybacks, returning excess cash to investor pockets, but after that merger, we do see they did do it through the shares outstanding increase, as noted here. So something just to keep an eye on, but hopefully in the future, they will continue to do share buybacks that they had previously done. And hence we can see that the reason for that drop in the ROIC here. Before that, we do see very strong double digits, well above that 10% minimum we look for, as we're looking for 10% or more to give us a signal that management are able to effectively allocate their capital. So when we look at the margins, very nice to see operating margin well above that minimum 12%. In fact, the last few years in the 40% region, very positive. Free cash flow margin, again, more of the same, especially the last 2 years in the high 20s. 2023 expected 20%. Now, net debt to EBITDA on the left, this is the earnings before interest, tax, depreciation, amortization. Shows us the dividend safety as well as the balance sheet strength. These show us the number of years it would take the company to pay off all of their debt net of cash on hand, and we want it below 3. 2023 is expected to be 4.24, and it's positive to see that next year, 2024, or this year in fact, but once we receive the annual report, it is expected to come down to 3 in line with the maximum we look for, so that is something positive to note. Now, in terms of the valuation, let's jump straight in. As always, when we do deep dives of companies, we run through all four models: Graham's valuation, multiples valuation, dividend discount, the DCF model, and then get to our intrinsic value. For today's episode, we are analysing 6 of Bill Ackman's stocks, so we'll jump straight into the stock valuation final tab. So the intrinsic value is the average of the 4 models, coming to around $87. So with the current price at around $79, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see effectively here it is a few cents shy of the current trading value. So we believe there is around a 10% margin of safety for Canadian Pacific in the current market. In terms of Wall Street and what they expect, we can see here they see around 10 to 15% upside over the next 12 months. So for the first stock, Canadian Pacific, based on our estimates and judgments, we see around a 10% margin of safety, with Wall Street expecting 10 to 15% upside over the next 12-month period. We then move on to the next stock, which is Lowe's company, ticker symbol LOW. 2023, they're up around 6%, again lagging the S&P 500. They are currently in the midpoint of the 52-week range with a yield of around 2.1%, and we can see their forward PE sitting at 16.32. Now, if you've been holding this over the last 10 years, you would be up around 330%, and we see their all-time high towards the back end of 2021 at just over $250 a share. Dividend safety score 93, very safe. Market cap 122 billion, mega cap company. And when we take a look at those recessionary metrics, well, they increased the dividend, they had above average growth, and they had a near S&P return with a negative 52%. Dividend growth, well, very nice to see that it is above that inflation of 4% that we target year on year. Now, the thing that is disappointing is over the last 5 years, we see 20% on average. The last 20 years, 25%. So in May last year, it was disappointing to see that drop. But at least it is above the minimum that we target, and it is one to keep an eye on. But I would like to see them bring it back up to the double digits we love to see. On a more positive note, they are a dividend king. They have increased those dividends over the last 50 years or more. Dividend yield theory, well, we can see our sign of undervaluation. Current yield sitting above the 5-year average, with the forward PE below the 5-year average of 17.5. Although when we compare it to the consumer discretionary sector PE, 14.4, Lowe's does sit slightly higher. Now, when we look at the free cash flow payout, very nice to see. 2023 at 37%. 2024 expected pretty much the same. So I would like to see this year a double-digit dividend increase. Free cash flow per share, well, $3 in 2014, $10.70 in 2023, so more than 3 times growth. But we can see the inconsistent nature of that. It hasn't been consistent growth year on year. 2024, though, it is expected to pick back up from 2023, so that is a positive sign. Sales growth now, 3 to 7% is the minimum, but we do see 2023 only 1%, so it didn't even keep up in line with inflation. So something just to keep an eye on. We would like to see it back up around that 3 to 7% mark that we typically see with this company. Numerically then, 53 billion sales in 2014, nearly double in 2023 at 97 billion. And one thing that is great about Lowe's company, they do consistent share buybacks, 1.06 billion in 2014, and then we can see 631 in 2023. So there's a positive sign. They are returning a lot of excess cash to investor pockets. ROIC well above 10%, and on top of that it is increasing year on year, so very nice to see, 51% in 2023. Operating margin, free cash flow margin, well, when we look at the operating margin, it does leave something to be desired. The last 10 years it hasn't been the greatest, although we do note the last 2 years has started to pick up, something that if I was an investor I would keep an eye on, ensuring that it doesn't come back down to the low levels we saw in 2019. Similar story on the free cash flow margin. Again, it has started to come down from 2021. So for Lowe's in particular, the margins would be something as an investor I would keep an eye on. Net debt to EBITDA, the other thing to keep an eye on, it has started to increase from 2021. It is expected to be around 2.75 in 2024. So the dividend does look to be safe. The balance sheet is fairly strong, but these are points that I personally, if I was an investor, would keep my eye on. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety at 10%, it is a buy up to $246. At 15% up to $233. At 20% still a buy at $219. And we can see right now for Lowe's, you are looking at around a 20% margin of safety. Now, what do Wall Street expect over the next essential 12 months? Well, they see upside around $240, so we can see they see around 10 to 15% over the next 12-month period. So in conclusion, for Lowe's, 20% margin of safety with around 10 to 15% upside over the next year. Jumping into stock number 3, we have QSR Restaurant Brands International. 2023 up around 19%. They are trading towards the upper end of the 52-week range with a yield of just under 3% and a forward PE of 23.65. Holding this over the last 10 years, we can see it has been fairly sporadic, up and down, a lot of inconsistencies, but we do note it is towards the all-time high that we have even seen in 2019 and not too long ago. So jumping in, the dividend safety looks to be borderline safe, a score of 45, 24 billion market cap, large cap company nonetheless. They did cut their dividend during the last recession. They had above average growth as well during that period. Dividend growth, similar to Lowe's, not that great last year, 1.9%, but again, we do see the strong nature over the last 5 years as well as the last 10 years in some strong double-digit growth numbers. Now, they have increased their dividend for the last 10 years, and we do note here a few dividend cuts that they have had to do. So let's take a look at dividend yield theory. We can see that yield is slightly lower than the 5-year average, so that is a sign of overvaluation. And the forward PE we see slightly higher than the 5-year average of 22.4. And when we compare it to the consumer discretionary sector PE of 14.4, QSR does sit comfortably higher at 23. So let's take a look at the free cash flow payout. Now, 2022 at 48%, 2023 expected 56%. Something just to keep an eye on. It has started to increase, but again, for now, it does look to be safe, and it does show us why we did see that very mediocre increase in 2023. Free cash flow per share, very inconsistent. 85 cents in 2013, went up to 5.71 in 2017, before coming down in 2020 and then rebounding. It does look very inconsistent. This is definitely something I would keep an eye on. 394 expected in 2023, so lower than the last 2 years, and 2024 expected to go lower as well. So something just to question as an investor or potential investor. Although do note sales growth the last 2 years, 2021, 2022, double-digit growth, 2023 expected 8% is looking very positive. And in fact, over the last 10 years, they have had some very decent top-line growth. As can be seen, 1.1 billion in 2013, 6.5 in 22, and nearly 7 billion in 2023. Net position over the last 10 years, your position as a shareholder has been diluted. 358 million shares in 2013, 455 in 2022. So let's take a look at the ROIC, around that 10% on average over the last 10 years, and it is positive and note over the last 2 as well as expected 2023, it is around that level. Free cash flow margin, operating margin, very nice to see, especially because the restaurant industry, if you've watched the channel, you know a lot of those companies do struggle with keeping up with these high operating margins and high free cash flow margins. So this is one of the better companies that we have analysed purely looking at a margin basis. Net debt to EBITDA, we can now understand why we see that dividend safety, 1, at a borderline safe level, and 2, why it had a mediocre increase. Their debt levels are very high, but it has started to come down, so that is positive. 5.61 expected in 2023, 2024 expected to go lower as well. So let's take a look at the valuation model, and don't forget, click on that pinned comment below. You can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. So margin of safety, we can start off with 10%, and we can see it is pretty much at the current trading price. And when we look at what Wall Street expect, well, again, they see around 10% upside. So in conclusion for QSR, remember this does come down to your own investment thesis, your estimates, so you could be looking for a much larger margin of safety. Right now, though, we're just telling you what the margin of safety looks to be based on our own estimates and judgments. So in conclusion, for Restaurant Brands International, we see around 10% margin of safety with around 10% upside per Wall Street targets. Moving on to the fourth company, we have CMG, Chipotle Mexican Grill. Last year, what a year in fact, up 62%, outperforming the S&P 500 towards the mid to upper end of the 52-week range, and a very high PE of around 50. Now, this isn't one that currently does pay a dividend, and over the last 10 years, we can see it is up around 315%. So let's take a look. Market cap, it is around 61 billion. It is a large cap company. And when we take a look at the free cash flow per share, well, $10 in 2013, $30 in 2022. So it has increased very nicely, around 3 times. Obviously, do note the inconsistencies. 2023 expecting to go even higher at $50. Sales growth, well, very, very positive. Double-digit growth nearly every single year. We do note that decrease in the top line in 2016. 2022, 14%. 2023, 13%. It does look like a very strong company in terms of growth. And when we look at that in terms of numerically, they've nearly 3 times their top line. $3 billion in 2013, 8.6 in 2022, 9.5 expected in 2023. They also buy back their shares, even though there aren't that many outstanding. 31 million in 2013, 28 in 2022. So again, they are essentially giving excess cash back to investors, even though they don't offer a dividend. ROIC, very strong. We do note some years below 10%, but the last 2 years, as well as 2023, expected to be very strong. Margins then, again, very inconsistent, but we can go off the last 2 years as well as 2023 on both the operating margin and free cash flow margin looking very positive. But with companies that have tended to have these dips, it is one that you should keep an eye on with the forward guidance as well as the earnings and quarterly reports. Net debt to EBITDA, very strong, 1.11 expected in 2023, 2024 even lower. So it does have a very strong balance sheet. And when we take a look at it from a valuation perspective, we can see what the intrinsic value is. Now for this company, we can't use the majority of the models. They do not pay a dividend. They have an incredibly high multiples valuation, so it doesn't make sense to compare it to the industry, and Graham's valuation isn't applicable to companies with incredibly high sales growth. So the intrinsic value is based off the DCF model, and we can see the current price at around 2217. If we look at a margin of safety of 10%, we can see it is pretty much trading at a 10% margin of safety. In terms of Wall Street, in terms of what they see, the upside, they see around 5 to 10% upside over the next 12 months. So in conclusion, for Chipotle Mexican Grill, we see around 10% upside, with Wall Street expecting around 5 to 10% over the next 12-month period. As always, though, do let me your thoughts as we go across. Are any of these companies you are looking to add? Do you believe them to be undervalued or overvalued? Now jumping into stock number 5, we have Alphabet, ticker symbol GOOGL. Now year to date, in fact last year they had a very strong year, up 57%. They are trading towards the mid to upper end of the 52-week range with a forward yield of around 24. They don't currently pay a dividend, and this is one that we have discussed on the channel before, being one of the cheapest tech stock companies in the market currently. Last 10 years we can see as well they are up around 381%. So the market cap, 1.71 trillion. They are a mega cap company. And when we take a look at the free cash flow per share, well, 85 cents in 2013, 4.59 in 2022. So it is growing, 6.10 expected in 2023 and expected to go even higher in 2024. Sales growth at double digits pretty much every single year, although do note in 2023 it is expected to slow down to around 5%. So something just to keep an eye on as to see whether or not Google's top line is starting to run out of some steam. But again, just something to be aware of. Top line then, 55 billion in 2013, 283 in 2022, expecting to be just shy of 300 billion in 2023. Shares outstanding, they do share buybacks. They've also issued shares. But on a net basis, over the last 10 years, they have bought back around 400 million worth of shares. ROIC, very nice, well above 10%. In fact, the last 2 years, as well as expected 2023, in the mid-20s, positive sign for management. Free cash flow margin, operating margin, not much to say other than the fact these are very strong percentages on both margins. And finally, net debt to EBITDA. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand, so they have an incredibly strong balance sheet. So let's jump into the valuation, and as always, do click on that pinned comment below if you want to essentially value and get to the current price, acceptable buy price of companies in your own portfolio or watch list, the pinned comment below. So margin of safety for Google, we'll start off with 10%. It looks to be a buy. At 15%, around $140, and at 20% we can see not quite. So we expect around 15 to 20% margin of safety to the current value of Google. And when we look at Wall Street and what they expect, we can see they are looking for around 10 to 15% upside in the current market. So in conclusion, for Google, we see around 15% margin of safety, with Wall Street seeing around 15% upside over the next 12 months. We then move on to the sixth and final stock, one we haven't actually analysed before on the channel, Hilton Worldwide Holdings. 2023 up 42%. They are trading towards the upper end of the 52-week range with a very minute yield of 0.33% and a forward PE just under 30. Over the last 10 years, if you've been holding this, your position would be up around 343%, excluding that dividend reinvested. Now, they have only recently started to pay dividends, so we don't have a dividend safety score just yet, but market cap is 46 billion. They are a large cap company, and we can see they have cut that dividend over the last 5 years, hence the negative average rate, and over the last 20 years, we see 9% on average. Now, taking a look at the free cash flow payout based on that dividend, it does sit around 8% in 2022, 2023 expected 9%, so we should really be expecting to see a nice dividend growth given how low that free cash flow payout is. Free cash flow per share, well, 561 in 2013, 574 in 2022, expected 658 in 2023, and we can see these strong inconsistencies when looking at that free cash flow per share, although it does make sense why in 2020 and 2021 it was very low due to COVID. Sales growth then, the last 2 years, 21-22, incredible growth to the top line. Not surprising given that drop in that COVID year where we do expect to see this rebound very strongly. 2023 still very strong at 26%, and if they manage to keep up this strong growth, then this could be a very interesting company to put on the watch list. $6.33 then, total sales in 2013. $3.74 in 2022, again just something to keep an eye on, but 2023 expected to go higher to $4.33 is positive. Shares outstanding, they both do share buyback, share dilution, but again on a net basis they have bought back shares, which is positive for the long-term investors. ROIC then, 23% in 2022, 28% in 2023, very positive to note. Again, operating margins, very positive. It is very strong. In fact, 57% in 2022, 54% in 2023. Very strong, and I like the way this has been increasing over the last 10 years. And the same could be said essentially on the free cash flow margin, 43% in 2022, 41% expected in 2023. Finally, the net debt to EBITDA, it did go up very high in that COVID year, but it has since come down. 2.82 expected in 2023, which is below that 3 maximum, so that is a positive sign, but again, just something to keep an eye on, given on how quickly it did move from 2019 to 2020. Finally, let's jump into the valuation, and as always, if you enjoy these kind of videos, smash the like button, hit the subscribe and bell button, and let me know if there are any super investors you do want me to run through their own portfolio. Intrinsic value then at $180. So we can see for HLT, it is pretty much trading at the current value, at the intrinsic value. And in terms of Wall Street and what they see, well, they see pretty much no upside over the next 12 months. So for Hilton, probably the only company, in my opinion, that isn't undervalued. You do have different margin of safeties, but out of the ones we looked at, this one is trading at its intrinsic value with Wall Street expecting very, very minimal upside. But as always, let me know your thoughts in the comments below. Are you adding any of these stocks? Let me know if you enjoy these type of videos, any other investors you want me to analyze. We recently did Bill Gates last week, so go check that out and let me know if there are any others. As always, click on that pinned comment below. You can get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, and just let me know your thoughts. As always, have a great day. Catch you on the next episode and take care.